So hello everybody for today's session on sustainable finance and investor impact at the Respond Days 2021. My name is Bryan and I'm responsible for the BMW Foundation Sustainable Finance activities and the BMW Foundation Impact Investing Fund. That being said, the foundation is both an active impact investor and an institutional responsible endowment asset owner, and of course an active philanthropic player in the field of sustainable finance. On a programmatic level, together with our partners, we're encouraging responsible leadership in finance across the public and private capital market spectrum. And that means we're working with venture capital and private equity funds, asset owners, institutional investors, as well as policymakers and industry actors to inspire capital market actors for impact and enable them to take responsibility for a sustainable future. So impact, as well as a just and equitable financial system, is at the core of what we're doing in sustainable finance at the BMW Foundation. And I'm very happy to speak today with Dr. Julian Kölbel from the University of Zurich, who is the head of research at the Center for Sustainable Finance and Private Wealth, and also a BMW Foundation Fellow. Julian, the Center for Sustainable Finance and Private Wealth is a long-standing partner of ours, and we're currently operating the Impact Investing Accelerator for Founders together with you. And we're also supporting research about sustainable finance and investor impact. And you have just updated the Investor Guide to Impact, which is a great guide for investors who want to change the world through their investments and who want to have impact. Julian, it's great to have you here. I'm very much looking forward to speak with you about how to have impact as an investor, and I would hand over to you for a short introduction.
Yes, thank you, Bryan. And it's a pleasure to be here at the BMW Respond Days. I am, as Bryan has said, the head of research at a center at the University of Zurich called the Center for Sustainable Finance and Private Wealth. So one of our big ambitions is to translate this broad desire to have impact in all areas of your life, but also with investments. And we see there's a broad-based desire and interest to do that. And our mission is to translate that into real meaningful change that we would like to see in terms of reaching the Sustainable Development Goals, equity, sustainability, and so forth. And our role is to do research on these mechanisms that underpin this idea, what works, what doesn't work, what should we look out for. And and I think that's what we're going to talk about, because that's something that we've tried to summarize in this Investor's Guide to Impact.
It's not always easy to define what impact is, and we also see it with our work. Many investors, they want to have impact, but they sometimes struggle to identify what impact really is. Maybe you can share with us, Julian, a little bit, what is impact for you?
Yes, I think that's exactly the right question to start with, because impact has become such a buzzword. Sure, who doesn't want to have impact? So it helps to put a little bit of clarity on what is meant by that. And I'll share a little visual to support what I'm saying. So we would say impact is change in the real world that is caused by your activities. Okay, and as simple as that sounds, it does get hairy in practice sometimes. So sort of to illustrate that, you could say you're interested in increasing the number of people who have access to drinking water, right? That would be your target parameter. That's what you want to have impact on. And then over time, there is a baseline sort of how many people have access to drinking water. And of course, many people are working on this, cities grow and so on and so forth. So there is a natural progression of that parameter over time. Now you do something, that's the activity. And then the interesting question is, after that activity, in the time afterwards, do more people have access to drinking water than they would have had if you hadn't undertaken this activity, right? So often that's also called the counterfactual, sort of what would have happened without the activity, that's the counterfactual. What has happened because of the activity, that's impact.
So that means if I have best intentions, but nothing happens due to, I mean, maybe my investment or due to my activities, you would say that's not impact. So just wanting something good and doing the best I can, but nothing changes. What would you say? What's a common fallacy in having impact or not having impact?
Yes, so intentions are important, right? I don't want to, so it is, that's the driver of all of this, that people have the intention to do something good. So intentions are important. Also, this idea of intentionality has a role. I would say it takes both, right? You have to have the intention, and then also you should be critical to see whether actually what you've done has led to a change, or whether what you see is actually the outcome of some other development. So it only seems that you had impact, even though, whereas in fact you didn't. And that can be problematic, because if you sort of evaluate something and you think, oh, you know, the numbers went up, we've had impact, although you actually did not, and then you start scaling that program to no avail, really. So it is important to evaluate these impacts. And yeah, so I think a fallacy is not to think about what would have happened without the activity. That is indeed true.
Yeah, this resonates very much with me, what I also see currently at the capital markets, also with these screening and maybe the impact investments. What does it mean in the investment context? And I think we have this discussion currently also with the European Green Deal, where many institutional investors trying to shift their assets to do something good. And the question obviously is, what's the right approach to have impact, and what's maybe just a good intention, but maybe not enough?
Yes, exactly. So if you look at this in an investment context, you basically have to introduce another layer, I think, to get things right. So what we do is that we distinguish between investor impact and company impact. Whereas company impact is that what we classically think about when we think about impact, right? It's the change in the world that are caused by company activity. So linking back to the example of drinking water, this company might, have a new type of fountain that is sort of very versatile and can be built in many places. And then, so through their products, they will increase the number of people who have access to drinking water. That's great. Now, I think a fallacy is to think, if this is, say, just for example's sake, let's say this is Nestle, right? And you own shares of Nestle, then sort of to think as an investor, I caused or triggered Nestle to do this sort of thing. I think that is misleading. Because you as an investor, you don't have to think about what does the company do where I happen to have shares in. You should more think, what is my activity? That is, you can invest, you can engage, there's various things you can do. And how does my activity as an investor cause change in company impact, right? So I think these are the two different levels you ought to look at to understand what is my role as an investor in this game of impact.
And are we looking here more into public equities or like public markets, or is it more a private equity concept? Because I guess it can probably be both, but is it mostly applicable to like public stock companies, or where can I have this impact approach?
Yes, so I think this framework is very general. I think you are completely right in your intuition that how it effectively works, that's very different in public and private markets. And we're going to get to that. But this idea that you separate the company impacts, what does the company do and what do I do as an investor, I think that applies really generally.
But I guess probably for public markets, it's probably a little bit more indirect, I assume.
Well, we could maybe go on to sort of what are the channels that we see how you can have impact as an investor. And there indeed, it does differ between private and public markets. So there are basically two ways. You can grow green companies or you can improve brown companies, right? And you can see this in this little figure here that there are companies that are already green. So they already have a positive company impact. And one way to increase that positive company impact is obviously if the company grows. So if you can, as an investor, scale the company activities which have positive impact, then you as an investor, you've caused a positive impact. And that works much better in the private markets, right? Because these are the companies that are constrained in their growth by financing constraints. So these are the startups looking for funding, but also the SMEs who would have capacity to expand, but they're looking for an appropriately priced bank loan to do so. So small and young companies, immature financial markets, and companies with intangible assets who don't have much to offer in terms of security and collateral. These are the companies where you tend to have the biggest bang for your buck as an impact investor. And of course, you have to make sure that their impact at the start is actually a positive one, right? You want to scale with positive impact.
I'm wondering, I mean, many of our viewers are probably also like private or retail investors, how we could call them. What does it mean if I invest now at the stock market? Is it applicable to me? Because I think grow green companies might be difficult for me. I mean, it's probably difficult to invest in private equity as a private investor. Does it mean I shouldn't invest in sustainable big companies at the public stock market and only try to improve the bad ones? Or what would be your recommendation for me as a private investor who has some funds in his bank account?
Yes.
Is it applicable to me, or is it something completely different?
No, it applies to everyone. And luckily, there are opportunities to have investor impact also in the stock market. It just works a little different than it does than in the private markets. Because one thing, you shouldn't kid yourself that if you invest, for example, in Vestas, right, the Danish wind turbine producer, and it's a classic component of every ESG and green portfolio. And for good reason, this company is a pioneer in wind power. And landscaping concerns aside, wind power is one of our most important tools in achieving a low carbon transition, right? So this company is doing something useful. But it's also a very large company at this point. And if you think of the number of wind turbines that they sell, that is mainly determined by the demand for wind turbines, sort of by the competitiveness of wind energy in various places around the world, also by the subsidies that it's getting. You buying a share of Vestas means that you buy that share from someone else. If there are few people who want to sell that because everybody wants to own Vestas, yes, then the share price, might trend upwards a little bit. But sort of the mechanism how that really helps Vestas to grow is relatively unclear. There are theoretical models that show this, and yes, that should make sense, but practically, empirically, we don't have evidence of that truly working, right? So you can feel good about owning Vestas, and there's nothing wrong with that, but you shouldn't sort of make yourself believe that because you bought Vestas shares, Vestas is supported and will henceforth sell more wind turbines. So I think in that sense, don't. That's a misleading thought. But what you can do, and this is a bit long, but what you can do in public equity is to encourage improvement of companies, right? And one mechanism that is, I think, totally underemphasized is engagement. As an investor in a company, you do have a voice. Of course, that voice gets louder when you're a big investor, but also as a retail investor, you can think of what, through whom do I invest, through which asset manager, and sort of question whether they do voting and engagement. Also in passive products, there are important points when environmentally or socially relevant issues are put up to a vote at the annual general shareholder meeting, and all shareholders have a vote, and it really matters which way these votes are cast, right? Pro sustainability or not. So there is
I think it's a very interesting aspect, because we see this discussion also at the public market with the screening, where you screen out like weapon manufacturers or some companies who produce tobacco or alcohol, or at least have a certain percentage of their productions in these fields. And what you say now is that if I buy a share from a good company, basically for the company, not too much changes, because it's a transaction. The company doesn't get more money because I'm just taking the share from somebody else who has got it already. So the company has maybe just an indirect effect, maybe through the share price, but probably more through like maybe publicity or these kind of mechanisms. But what does it mean for me now as a private investor? Does it mean should I now buy the brown companies and try to improve them? That would mean that the screening approach that many follow would be basically not the one that you would suggest? Or would it mean I should buy the good company and then accept that my impact is maybe limited because there is no lever for change there?
Well, before you make that choice, I would recommend that you ask yourself, why am I investing sustainably in the first place? Because I fully accept that many people like to be invested in companies that they like, right? That they can identify with, and sort of to avoid companies that they find for whatever reason unacceptable. And that is kind of a value alignment consideration that I completely accept, and by all means do that if that's what you want to do. If you say, well, actually, I want to utilize my capital to change the world, then I would recommend, well, then you have to be a little bit more strategic about how that works. What I concretely would recommend is pick funds that first have a voting and engagement policy, so that actually do this type of work. And second, it can support when they also screen out companies, but not at an industry level. Sort of, if you say, well, this is tobacco, this is not investable, then there is zero incentive for that tobacco company to change, because they know they will, whatever they do, they will always be a tobacco company. If you instead implement screens such as, in the fashion industry, we want the company to adhere to the following best practices and also report on them with regards to child labor. Then for that company, they see, well, if we tick this box, if we implement those practices, we are eligible for these sustainability funds. And then there's a clear incentive why you might want to do that. And that supports the engagement on the other side. Sort of, you make the company aware, look, we would like you to do that. Plus, our investment policy is actually such that if you do that, we'll invest more. And that's a pretty clear case for a company to start responding. So these two things, voting and engagement and screens on practices, that's what I would recommend for retail investors to look out for when they pick investment products.
It feels to me that it's also what we're currently seeing in the market. We see very active investors, for example, like Engine No. 1 in the United States, who I think did something that is very similar to your engagement approach. And we also see many institutional investors with their assets who apply a kind of screening and obviously also active engagement approach, even though more passive than Engine No. 1 does, more like exercising their votes on the annual meeting, maybe having indirect engagement with the company leadership, something like this. But it feels to me it comes also down to kind of almost like ethical or philosophical questions, like, do I want to make my hands, like, do I want to refrain from make my hands dirty, then I do it like a screening approach, or do I want to have impact? And then maybe this would mean invest in a company that is brown and then try to change it. I think it would be interesting to see if you have any examples of these two approaches, apart from the ones that we just mentioned, but to make it maybe a little bit more tangible.
Yes, I was hoping that we're going to go the philosophical way, but maybe we can do this later. And now first put some practical examples in here. So one sort of really clear example for the channel of scaling positive impact is coming from this Root Capital, which is an impact fund financing the Musasa Coffee Cooperative in Rwanda. So you can imagine this is a coffee cooperative of about 100 farmers, and they sell raw coffee locally in the local market for a pretty low value add, right? They have good coffee, and they could catch a much higher price by selling their coffee as a specialty coffee directly on the world market, right? Sort of to some fancy cafe in London, for instance, who will then say, well, this is locally only from Rwanda. But to access this market, you need to roast the coffee, and you need to invest a little bit in these relationships, packaging, branding, and so forth, right? So it doesn't just work like this. So here is a role for an investor, and this is what Root Capital has done. They basically financed that business upgrade and obviously helped the coffee cooperative, to improve their business and profitability, and participated from that as an investor as well. So it was sort of shared value here. And this is now, okay, so this is somewhere really out in the countryside, and there wasn't a bank that would give a loan, in order to pull this off. So they were stuck. And in this case, the investor unlocked something that wouldn't have happened otherwise. Okay, and the positive impact is, of course, that these are jobs in an area where there are not many jobs. So the coffee is also well, I actually don't know if the coffee is grown ecologically, but that may be the case. But maybe the primary benefit here are jobs in sub-Saharan Africa, which is clearly something that is needed. So this is, yeah.
I think the impact is very clear. I'm just wondering, is this something that I could invest in as a retail investor, if I like a private person? And I also think it's going to be quite hard to find these investment opportunities, even for institutionals, maybe even as a foundation. I mean, it would be great to invest in them, but I mean, you probably need somebody who brings these opportunities to you. I think that's probably also the reason why they're underfunded, because it's very hard to find them. Or what do you?
Well, that is exactly the reason, and I think this is coming, right? I mean, of course, if you are on your own and now you sort of start, browsing the internet for other coffee cooperatives, this, that doesn't work. You need intermediaries who are there locally, who have met the people, who have looked also at the financials of this coffee cooperative. I mean, this could also be a horrible investment that just disappears, right? So you need intermediation here. But this is what financial markets are good for. This is what they do all the time. And this is just a new segment that will, if there is enough demand, also from retail investors, will grow. This is related to the whole microfinance movement, which is already quite established, and it has led to professionalization. There's now an investment value chain, sort of larger institutions that feed to smaller institutions locally. So this can work. This can work with intermediation. So you just have, if you want to do that, you just have to look out for providers who offer this type of investment, and be a little critical. Ask them really, what is the impact really? How do you source these deals? As with all investments, right? Ask and be a little critical, but then this can work.
It's actually also something that we're doing at the BMW Foundation. I mean, these market making and building up these intermediaries is obviously something that a foundation can help scale. But to be fair, it's also like a difficult task because the skills you need for the assessment, the due diligence, everything, it's not so easy. I mean, on the one side, we are trying to build these intermediaries, but with our impact investing fund, we also want to invest in them directly. And yeah, I mean, I think we personally also see the struggles that come with these kind of investments, that where you see the big impact, but who also feel a little bit risky, to be honest, because it's difficult to assess, and it's also sometimes geographically far away, and you really need to rely on these intermediaries who make it easier for the investors, like a foundation, but also for others, like bigger capital providers, to make it investable. So I think there's huge value, but there's also still a lot to do to make it easier for the capital to flow into these high impact businesses. Do you also have an example for the public market engagement?
Yes. So, as you said, this is probably for everyone should be a small part of a portfolio, because these investments are risky. They are more risky than some plain vanilla stock market or even credit investments. So it's important to use the whole portfolio, like sort of decide how much you can bear of that sort of investment in your overall portfolio, and for the rest, pursue other channels. And here's an example on engagement, which I believe is an enormously important impact channel. So this is on Sinopec, a Chinese oil major, and a story of an engagement dialogue that was led by Hermes. That's one of the providers that does that sort of thing. And in oil production, you often have uncontrolled methane leakage. And methane, you might know, is an extremely potent greenhouse gas, much more potent than carbon dioxide. So every cubic meter of leaked methane is pretty bad for the climate. And you can capture that methane during production. Either you sort of burn it right away, or even better is you capture it and put it in a tank. And so through this dialogue, Hermes basically pointed out that, this is available, this technology, other oil majors are doing it, the costs are actually bearable, and plus it really will look great on your environmental record, and sort of started to convince management that that would be something they should, put aside some investment funds for, and some engineers to pull this off in their production. And as an outcome, Sinopec has done this and saved 440 million tons of CO2. That is, so CO2 equivalents, of course, and that is quite a bit. So that's kind of the, a small country per year output of greenhouse gas emissions. So it's a big impact, even though the company is still, of course, an oil company. So overall, it still contributes to climate change, and it still is, one of the, not an ESG darling with compared to Shell and BP, perhaps. But that's to point out that sometimes there's a lot of potential for improvement with the companies who aren't that far down the sustainability road, and that's
it feels to me a little bit. I mean, this is a good example for engagement, but are there enough engagement opportunities out there? I mean, this if I have like oil or energy companies, I totally see the lever. Engine number one just recently also saw a big lever with Exxon. Are there enough engagement opportunities out there that this can be a viable strategy, or would you say they're limited ones, but it should be a part of your portfolio?
I think there are countless opportunities for engagement left around the world. I mean, especially because you cannot only do this on climate issues, you can do this on all sorts of issues related to the Sustainable Development Goals in all countries around the world. So there's always, good things that are maybe already being practiced in Denmark that are not being practiced in Thailand yet, that you can sort of transfer. So I don't see a shortage of opportunity at all. What I do see is a certain limitation on how far this can go. And I think that's very important to understand that through engagement, we're not going to pull off a transition to a low carbon economy, right? So it works to ask Sinopec, can you please capture this methane? What would be a hard sell is to say to Sinopec, well, could you just actually leave these resources in the ground and instead, pursue something completely different in renewable energy? For that to work, this has to rely on some governmental action also in terms of really steering the economy. And the important thing is demand, right? As long as there's demand for oil, coal, gas, someone will produce these fuels. Government's role is sort of to manage the demand for these fuels, and that is what's ultimately changing or achieving the big transition. But
yeah, and it probably also means like institutions and structures for these investors to align, like maybe what is called Action 100 Plus or IIGCC, because I guess just one investor sometimes has a very hard job convincing a company if the other ones are not following. So I guess sometimes there are probably also practical issues to make this engagement work. If I'm now an investor and I want to go this path of investor engagement, how do I find these funds?
Yeah, that's a good question. What I sort of, as a general advice, you are probably already, associated with some bank or asset manager, and that will usually be your first step to ask what they have on offer. And then I would just recommend digging a little bit deeper. If they say, okay, here's our sustainable investment product, ask, what are the holdings? What is the investment policy? If they say this is an impact fund, ask them, how does it actually have impact? Can you tell me examples how it had impact? So that's, what is being offered to you, that's how I would sort of question it. Also, what we have new now in the European Union, Article 8, Article 9, they are now used as labels. What they effectively mean, Article 9 basically means, well, there are companies in your portfolio that have really beneficial economic activities. That's great from a value alignment perspective. That's, to me, not fully convincing from an investor impact perspective yet, right? What is really a market gap, I think, sort of some sort of labeling or grading scheme for investment products with regard to impact, I have to say, yes.
So Julian, so you said on the one side, I have this approach of providing capital to undersupplied markets, the one that Root Capital does, that you just said. And for public equity markets, I have this engagement approach where I invest in companies or in fund managers that engage with the companies and try them to be better and make the brown ones greener. I'm wondering this big bucket of screening and best in class where I invest in companies that are already good. Can you maybe elaborate once more on what to do with them? Because I guess I cannot put all my money into the brown companies. That would also be not beneficial. So what's your suggestion with these other parts of my portfolio?
Yes. So from a scientific point of view, we're basically saying, well, for engagement, we have evidence that this is working in terms of investor impact. For screening, best in class, for instance, there are, in theory, this should also create an incentive for companies to improve. But empirically, we haven't seen it yet. It may still exist. We just can't prove it, right? So I'm not saying don't do it. I'm just saying, well, it's unclear to what extent this has impact. Now, what we did uncover, though, is what is most likely to have impact, at least based on these theoretical models. And that is basically the idea is if there's a tilt of investors towards green companies, right, then the prices of these green companies should rise. And then of the remaining brown companies, they should say, well, we also want to get this premium, let's do something so that we get into the green bucket. that's kind of theoretically how it should work. There's a couple of things that need to happen. First of all, companies have to become aware of that, and this premium has to have a reasonable size to justify investment. But the main thing is really the cost of improvement. Sort of how much does it cost to, to sort of curry the favor of the green investors? And that's why we would recommend these screens in best in class. And that's actually what best in class does. It's within industry. So they don't say tobacco and oil is out of the portfolio, because then these companies are just out of the portfolio, no chance of entering it. But they say instead, within the oil sector, we line them all up, these companies, and they say, these are the 10 best ones, these are the 10 worst ones. And then, in theory, the companies at the lower end of the spectrum, they should try to compete and do something what the ones on the top are doing.
And probably the companies that are at the top can also use this for like, I wouldn't say marketing, but they can use it as a lever for their operations, and also use it for their purposes. If I summarize this now correctly, I would try to attribute one bucket of my investments into impact investments and high impact businesses. I would attribute some assets to the engagement bucket and make sure that I improve brown companies, and I would have some assets in this bucket of best in class to support the companies that are doing good. Are there any more recommendations that you could give investors if they want to have impact with their investments?
Yes, I think there would be one more thing to do, but basically you've got it completely right. So what we usually recommend is sort of in your asset allocation, it's really an asset allocation decision. Sort of how much can you even do this sort of startup private equity lending or financing? And once you figured that out, that's a decision about how much risk and illiquidity you can bear. Then you can pursue these opportunities. Second, yes, encourage improvement across the portfolio. I think the primary channel will be voting and engagement. For that, often you don't even have to change what you're invested in. You can just sort of add this on top. If you go for funds that screen either ESG integration or best in class, then you should first of all do this in both equity and debt. Focus on broadly supported ESG practices that not only you are saying are important, right? Sort of this idea of investor coalitions, and think about that they can be implemented at reasonable cost. So basically, turbocharge the low-hanging fruits in a way, right? That's what you can achieve. And the third thing is, I think also supporting systemic change is an important role also for investors, and that's really where industry inclusion has a role to play. So if the University of Cambridge says, which they've recently concluded, that they are not investing in fossil fuel anymore with their endowment, that shifts a little bit the debate, where that is not a fringe position anymore. That is sort of, the position of a serious, successful UK investor with a lot of money behind it. So then politically, the whole idea of perhaps living one day without fossil fuels or in a carbon net zero economy becomes more credible, more realistic. So that matters. And it emphasizes the need then for political change. And investors have a voice there. You as a retail investor, that's maybe more like if you say, well, I'm not investing in fossil fuel, and then that's a conversation around the lunch table where people, realize, oh, wow, you are serious about this. And maybe the next thing you'll equip your house to be energy self-sufficient and things like that. So I think that's a third thing I would highlight. Wherever possible, if that's your goal to have impact, also support systemic change, and that means being vocal about your investment decisions there.
that makes a lot of sense to me, and it's obviously also an area where foundation can work in,
Truly,
or through policy, for example, but also to move more capital towards impact. Because if I understood you correctly, once the amount of money that is in these green finance or sustainable finance field rises, there will at some point be also more pressure on the investment on the companies that are at the bottom level of the best in class range, right? I mean, if the majority of the investors are taking these decisions, these criteria into their account, then obviously there will be also some kind of market pressure. You know, I think that was very interesting, and you have these investors guide to impact where our audience can get even more information on how to have impact as an investor. Maybe to sum up and summarize, is there anything that you think is coming up in terms of research or next steps that is important? Can you give us a little bit glimpse on what's coming up in terms of research and what you're working on that could be also interesting to our audience?
Yes, so at the Center for Sustainable Finance and Private Wealth, we are embarking on a research program with the mission to answer some of the remaining questions that we've also identified in that guide. So basically, we've summarized what is known to date, but of course, whenever you do that, you uncover some questions that are still open. And one of them is certainly this of the empirical investigation of these best-in-class and ESG integration funds, right? That's a piece that's missing. We are currently working on that. We've actually started it qualitatively. So we started talking to investor relations people and CFOs at corporations and asked them, you know, how does this market shift affect you in your financing and in your strategy? What we're seeing there is that, well, it is a second order concern for them. So really the main concern of how they operate strategically is still, you know, market demand, technology, regulation, that really drives them. But they are aware of ESG and that it's very important. And we're also seeing that the thing where ESG investing has to get better is to be very clear what are actually the expectations with regard to ESG, and are these just, you know, announcements, or does investment follow if you were to actually implement that? Because from the company's perspective, there's a bit of a commitment problem that they say, well, if we now, you know, take, I don't know, 20 million or 100 million to implement something of substance, will we also be rewarded next year by investors who say, okay, you know, well done, we increase our position, or, you know, or do they have other concerns next year? And then, you know, so investors have to be authentic in their calls for ESG improvement. And I think that's actually something where engagement and screening kind of probably should work in hand, that you say, well, you know, we engage, we have very clear demands that what we expect of companies, and then we also back this up by, you know, increased investment later, or, you know, or we sell if they didn't do it.
Do you also see a big role in transparency and standardization of impact measurements? Because I think that's probably maybe one major lever to also show the non-financial performance of the company to the investors, because otherwise it would be very hard for them to steer their investments.
Yeah, I think it is exceedingly hard to really measure impact and aggregate it over all these different categories, right? Sort of to give a sort of brutal example, you know, the ratio of women on the board and carbon emissions are both important things, but sort of how many women have to sit on the board to compensate for 100 million tons of carbon emissions? No one wants to, you know, give you that number for good reason, right? These are kind of, you should work on both of these things. And that's something that I like about engagement, is that you can really narrow down and be very concrete, company specific on what is, what's the most useful thing that this corporation can play in this, global drive towards sustainability, and really focus on these things. And then measurement is not so hard anymore when you figured out where the priorities lie. Yeah, I sometimes, of course, everybody wants, I think we should have a framework that's not too difficult. And we should then, accept that it's not perfect, but at least we have a framework. And then these are the 20 indicators. And I think we can work off that. I think it would be super helpful to have something imposed top down. And then we can still have flexibility in work with that framework, whenever the analysis goes deeper.
Julian, I think that was extremely helpful to cut a little bit through the fog of how to have impact as an investor. I hope that our audience could take a lot out of it. I personally could. So thank you very much. And again, I think for more information, have a look at the Investor's Guide to Impact that you published at the CSP that gives you even more information. Julian, thank you very much.
Thank you very much, Bryan, for having me. It's always a pleasure to speak about these topics, and thanks for your great questions. And I wish you the best of luck with the BMW Foundation, to pursue these topics further. I'm looking forward to it.
Thank you, Julian.